Welcome to the Deep Dive. Today we're really getting into the latest numbers from Bandhan Bank Limited. We're looking at their first quarter for fiscal year 26. Our plan is to, pull out the key insights from all their recent stuff reports, calls, presentations, just to give you a clear picture of where they stand. Think of it as your shortcut, really.
Yeah, and what's interesting here, I think, is that you get the headlines, sure, but diving deeper lets us see the underlying strategy, right? And how it fits into the bigger Indian financial picture.
Exactly.
And Bandhan, well, they're known for that financial inclusion focus, so it's a great case study on navigating, economic shifts and regulations. We're not just looking at what happened, but why it matters for their specific model.
Absolutely. Okay, so let's start with the big picture, the main financial numbers. They reported a profit after tax pity of 372 crore rupees for Q1.
Right.
Now, here's where it gets interesting. That's up 17% from the last quarter, Q4, which sounds good. But it's a huge 65% down compared to the same quarter last year, Q1 FY25, when it was over 1,000 crore. That's quite a contrast.
It really is. And you immediately ask, well, why such a big difference? And it turns out Q1 last year was described by them as exceptional.
Oh, yeah.
Particularly for their micro banking side, which, well, hit some challenges later on. Also, this quarter's profit is purely from operations? No, one-off boosts.
Unlike Q4?
Exactly. Q4 had that 123 crore from the ECLGS scheme. But on the operational side, things look a bit better. Operating profit was up 6.2% sequentially, so some improvement there.
Okay, efficiency improving. And what about those key ratios, ROA and ROE?
Right, return on assets was a 0.8%, return on equity at 6%, both up slightly from Q4. Small improvements, but showing, maybe things are stabilizing operationally.
Okay, so that's the top line. Let's dig into the engine room now. Net interest income, NII, and net interest margin, NI.
Wow.
Crucial for any bank.
Absolutely core.
So NII was 2,757 crore, pretty much flat compared to Q4, but down 7.7% year on year. And then in, settled at 6.4%. That's a drop of 27 basis points, so 0.27% from the last quarter. What's driving that squeeze on the margin?
Well, there are really three main things squeezing that in. First, they're deliberately increasing the share of secured loans.
Right, which have lower interest rates usually.
Exactly, lower yields than microfinance. Second, you've got the impact of the RBI cutting the repo rate recently. That filters through.
Okay.
And third, there's still some lingering pressure from higher slippages loans going bad in certain parts of the portfolio.
Right.
But what's quite interesting here is how they manage their funding costs. That actually improved. Cost of funds went down 19 basis points from Q4.
Oh, how did they manage that?
Largely because they cut the interest rates on savings accounts back in April. So proactive management there.
I see.
And don't forget non-interest income. That was actually quite strong, up 33% year on year. Yeah, big boost from selling some investments. That's treasury income, about 250 crore. And also income from selling third-party products like insurance or mutual funds. That was up 73%. So they're definitely pushing other revenue streams too.
Diversification in action there. Okay, let's talk about the loans themselves. The overall loan book, gross advances, stood at 1.34 lakh crore. That's 1.34 trillion rupees.
Huge amount.
Yeah, it's up 6% compared to last year, but actually down 2.5% from the previous quarter. So what's the story behind that? Why the sequential dip? And what's this diversification you mentioned?
This really gets to the heart of their strategic shift. They are consciously pivoting. The big highlight is the secured loan book. That grew 29% year on year. It's now over 52% of all their loans. A year ago, it was only 43%.
Big jump.
Massive jump. It shows they're serious about building a more, let's say, stable asset base. And you see that in the non-EEB portfolio, that's non-microfinance stuff.
Right.
That grew 27% year on year, nearly 60% of the total book now. Breaking it down, retail loans, excluding housing, jumped 78%.
Wow, 70%.
Yeah, impressive. Wholesale banking up 32%, housing up 15%. But on the flip side, the traditional EEB microfinance book, that actually shrank by 15% year on year.
Okay, so a clear shift away from microfinance dominance.
Reflects those challenges they mentioned and probably those industry guardrails that came in to manage risk in microfinance lending.
Got it. So we've seen this shift in lending, but banks need money to lend deposits. Total deposits grew a healthy 16% year on year, reached 1.55 lakh crore.
Yeah, growing faster than loans, which is good for stability.
Definitely. But what's the story with their SEGO ratio, the cheap current and savings accounts, And how are they actually getting these deposits in the door?
Right. Well, the overall deposit growth is strong, especially retail term deposits, those fixed deposits from individuals,
Hmm.
up 34% year on year. That shows, customer trust, effective branches.
Mm-hmm.
Retail deposits overall, that's HSA, plus those term deposits make up about 68% of the total. Pretty stable, good granular funding. However, the CSA ratio itself, that did dip a bit, down to 27.1%. They put that down to, well, typical Q1 slowness, seasonality.
And the rate cut.
And definitely that cut in savings rates in April. Some money likely moved from low-rate savings to the higher-rate term deposits they were offering.
Makes sense.
But they've been active. They had this one-band hand drive, the Deposit Grow Together campaign, apparently brought in 4,200 crore in new retail term deposits in just 40 days.
Wow. Focused effort.
Very focused. Launched new elite accounts for richer customers, trained up staff in over 2,000 banking units to push term deposits. So yeah, a real push on that front.
Okay, deposits, loans. Now, the crucial bit, asset quality. How healthy are those loans? Gross NPAs at 5.0%, net NPAs at 1.4%. What's the real story there? Are things getting worse?
Well, it's interesting. Those NPA numbers did tick up slightly from Q4, gross up 26 basis points, net up 7. But, and this is important, they say it's mainly because the total loan book shrank slightly quarter on quarter. So the percentage looks a bit worse, even if the actual amount of new bad loans didn't surge.
The denominator effect.
Exactly. In fact, gross slippages, new loans turning bad, actually declined from Q4, down to 1,553 crore from over 1,700 crore. Slippages in the EEB microfinance segment also eased off a bit.
Okay, that's a positive sign then.
It is. They also did some technical write-offs, about 1,047 crore, mostly from EED. That means taking very old, likely unrecoverable loans off the main books, though they still try to recover them.
Right. Cleans up the balance sheet view.
Correct. And their provision coverage ratio, including those write-offs, actually improved to a pretty healthy 87.3%. And collections in microfinance, the EEB part, stayed strong at 97.6%.
Good collection efficiency. What about that mention of a procedural change affecting SMA 0?
Yes. The special mention accounts, 30 days overdue. Apparently, a change in how they handled demanding payments on holidays caused a temporary spike in that SMA 0 pool, especially in West Bengal and Assam. But they see these as recoverable people, just pay the next working day. They expect maybe another small blip in Q2 due to festival holidays, but they're saying it's, not a major underlying worry.
All right, understood. And credit costs?
Credit costs also improved slightly, down to 3.5% from 3.9% in Q4. And one more point, their internal analysis suggests 90% of their microfinance borrowers only borrow from Bandhan or maybe one other lender.
So not overly indebted elsewhere.
That's the implication, trying to ensure affordability, especially after those industry guardrails came in.
Okay, that covers the core financials and asset quality. Beyond the numbers, what else are they doing? What are the strategic initiatives pushing them forward?
Well, digital is a big one. They're really leaning into it. For instance, using WhatsApp for loan recovery efforts.
Oh, how's that working?
Apparently quite well. 88% message delivery, and for 80% of those delivered messages, it actually led to a recovery.
Impressive use of tech.
Yeah. And they've rolled out QR code payments for microfinance EMIs, lets people pay 247, reduces manual collection work. Overall, they say 98% of retail transactions are digital now.
Wow.
And 92% of new savings accounts open digitally. So big shift there. They've also expanded their government business, collecting taxes, paying pensions, even doing salary accounts for the Indian Air Force.
Interesting diversification.
Definitely. And in wholesale banking, they closed their first debt syndication deal, growing their non-fund business too. Plus, still expanding the physical network, 1,750 branches now, 3.14 core customers.
Okay, quite a lot happening strategically. So let's try and wrap this up. What's the main takeaway from this Q1 FY26 deep dive?
Well, I think
it seems like we're seeing a bank, Bandhan Bank, that's really actively pivoting, doesn't it? Moving towards more secured loans, diversifying away from just microfinance.
Exactly, a clear strategic pivot.
While also working hard on managing the asset quality from the older book and really pushing digital hard. But they're still navigating those headwinds in their traditional microfinance space.
Yeah, it's a story of resilience, I'd say, and deliberate adaptation in a pretty dynamic environment. They're managing challenges while building for a different kind of future.
So connecting this to the bigger picture.
Well, Bandhan's experience really highlights that classic tension, especially in markets like India, between going for growth, sometimes aggressive growth, and managing risk carefully.
Hmm.
And it brings up, I think, an interesting question for you, the listener, to mull over. As banks like Bandhan embrace technology and diversify their businesses, how do they make sure they don't lose sight of that original mission?
The financial inclusion part.
Exactly. Reaching the unbanked and underserved. How do you balance that with building a, robust, diversified, profitable bank for the long term?
That is a fascinating thought to end on, especially given Bantin's unique roots. Hopefully, this deep dive has given you some valuable insights and a solid grasp of their latest performance.
Hope so.
Until next time, keep exploring, keep learning, and stay well informed.